Good morning, everyone, and thank you for dialing into our Tax Matters monthly webinar. I think this might be the 6th or the 7th Tax Matters webinar that we've run so far. The aim of these webinars is to give you a brief overview of what we see as the significant issues and announcements across the GCC in VAT and tax. And it really supplements our weekly tax flash emails, which we send out every Thursday afternoon, basically giving a quick update of whatever new announcements or changes in laws or guides that have come out in the week. So if you're not on that list, please reach out to anyone in the Keypoint Tax team or email that at keypoint.com and we can add you to that list. Your presenters today will be myself, Mark Gamble. So I lead the indirect tax team at Keypoint, and I'm joined by Dinesh Ravi, a manager in our direct tax team, and Tariq Haq, a manager in our VAT team. We'll also be assisted by a panelist, Adil Falzi, who is a manager in our direct tax team, ready to take any questions that you have. We do want to make these webinars as interactive as possible. So that really does mean answering as many questions as we can. So if you do have any technical issues or I guess any queries or concerns around VAT treatment or tax treatments in any of the GCC countries, please ask a question. There's a Q&A widget on your Zoom, either at the top or the bottom of your screen. Please feel free to ask. Throughout, we will try to answer throughout, or we'll save some time at the end to go through them. If we don't get around to your question, don't worry, we'll send you a written response sometime tomorrow, and we'll circulate those responses throughout all the attendees. So yes, please ask any questions you have. And with that, I'll pass over to Tariq, who will take us through some important updates in Saudi Arabia.
Thanks, Mark, and good morning to everyone dialing in today. There's been a fair number of updates in Saudi since our last webinar in March. The first update is around the first integrated logistics zone in Riyadh. So Saudi has a vision, obviously, making it one of the 10 sort of largest city economies in the world. And with that, they've launched this first integrated logistics zone. The focus is on trying to make Saudi a competitive transportation and logistics hub. And companies that will be operating inside these economic zones will benefit from a 50-year tax holiday. And that will include things like VAT suspension, when goods are under a custom suspension scheme, 0% corporate income tax, 0% withholding tax on certain types of payments. And they've also done a 100% business ownership model with no restriction on capital repatriation. So that's a pretty big move to hand out a 50-year tax break, and it shows that they're quite serious in getting companies to relocate their head offices and other operations in Saudi. So that's that. A bit about Gazette ongoing amnesty. The Gazette penalty waiver is still available, but the reduction has been reduced to 75% of the tax liability if it's disclosed unpaid by the 31st of May. The 100% cancellation obviously expired on the 31st of March. A bit about the draft e-invoicing requirements. The Gazette's urging taxpayers to provide their opinions on that by the 17th of April. It includes things like technical specifications and procedural rules the Gazette has set out recently. We recommend taxpayers consider providing sort of constructive feedback for the Gazette to consider, as it may well then end up making a difference if a sufficient number of people say the same thing. I'll pass it back over to Mark to go over the remaining updates. Okay, so over to you, Mark. Thanks.
Thanks, Tariq. So yeah, look, just before I move on, the e-invoicing point, I think, will be one of the more important issues this year. All businesses operating in Saudi need to issue e-invoices from the 4th of December of this year. So it's going to be a big systems change for a lot of businesses. So that will be the big thing. Some other updates. Towards the end of March, Gazette released a tax circular on the VAT transitional provisions in Arabic. So this circular was basically restating what the transitional rules guidelines had already stated, but it provided more information around the meaning of contract renewal. For those operating in Saudi, you'll remember that one of the transitional rules related to contracts, and you could apply the 5% up until the contract renewed or cancelled. So it just gives a bit more information about what they're meant by contract renewal. Following from our last webinar, just another reminder that non-residents that have incurred VAT in Saudi during calendar year 2020 should review whether they are entitled to claim a VAT refund. So at the moment, Saudi doesn't have a set process for non-resident refund claims, unlike Bahrain and UAE, but you can make the application and the deadline is the 30th of June. Gazette continues its inspections of businesses. This seems to be kind of a regular update, and it's one of the main news articles on the Gazette websites quite regularly, basically just reinforcing that Gazette is being very active with their inspections and is definitely fining taxpayers for non-compliance. And just finally for Saudi, last week there was an agreement signed between the Gazette and one of the universities with the aim of developing a specialized program for zakat and tax. So it's more just an indication that Gazette's really investing in developing the junior cohort and really specializing in zakat and tax. So I guess it's just a sign of things to come. I'll pass over to Dinesh now, who will talk through some of the basics of calculating zakat.
Thanks, Mark, and good morning, everyone. There has been no significant tax or zakat update last month, but increasingly many of our clients are asking how to calculate zakat liability. What are all the items to be added and deducted in the zakat base? So we thought, like, in this webinar, we will be covering the basic understanding of calculating the zakat and key points to remember while preparing your zakat 2020 zakat return, which is due on 30th April 2021. So as these points will also help the company to avoid query or minimize the risk of significant zakat assessment from the Gazette. On 14th of March 2019, the General Authority of Zakat and Tax published a new zakat regulation under Ministerial Resolution number 2216. The new regulation are effective from the fiscal year commencing on or after 1st January 2019. Please note that there is separate rules for financial institution to calculate zakat, which is under Ministerial Resolution 2215. As everyone knows that zakat is a religious levy which is charged on the Saudi shareholder of the company. Zakat payers following Gregorian calendar, that is 365 days, are subject to zakat at 2.578%, excluding the adjusted profit, and adjusted profit are subject to zakat at a rate of 2.5%. So your zakat liability will be 2.578% of zakat base, excluding the adjusted profit, plus 2.5% of net adjusted profit. And one more important point, where in case your zakat base is in negative or lower than the adjusted net profit, so in that case, the minimum zakat base will always be your net adjusted profit. The basic components of zakat base are addition and deduction of the items in the zakat return. So the addition items includes three components, which are like internal source of equity, which includes share capital, retained earnings, statutory reserves, provisions. So these are all forms your internal source of funds. If there is any changes in increase in share capital during the year, the increased value should be added to the zakat base. And then the next one is external source of funds, which includes short-term loans, long-term loans, due to related party, accrued expenses, advance from customer, or any other payables. So these are all the form of items that forms under the category of external source of funds. Under this, any liability that remains with the company for 1 year will be subject to zakat, where in case where the liability expect to overlap between the two financial year, then the proportionate days that is outstanding in the current year will be added to the zakat base. And the last addition component is net adjusted profit, as I mentioned earlier, which is subject to zakat at 2.5%. On the other side, that is deduction of asset, company can claim a deduction on fixed assets, intangible assets, spare parts, long-term investment, and capital work in progress. So these items, if you have in your financial, if you have in your books, you can claim a deduction on these items. Next slide. In the previous slide, we saw the addition and deduction of the items in the zakat base. Here we will see the important points to be considered while you prepare your zakat return. The important point is like while you calculate your zakat, the external source of funds added to the zakat base are restricted up to the total value of deduction. This is the new point that came up in the recent regulation. For example, let's assume like company has added a 3 million of external source of funds to the zakat base and has deducted only 2 million of fixed asset in the zakat base. So in this case, your external source of addition will get restricted only up to the total value of deduction, which you are deducting in this case is 2 million. So your addition will be up to the level of 2 million in your zakat base. And then next point, this is a favorite point, like most of our clients used to ask these questions. Like we have a foreign investment in outside KSA. Can we claim this as a deduction in the zakat base? So as per the new regulation, which says like, yes, company can claim an investment in foreign entities in the zakat base, provided they have to satisfy 3 conditions, which are the minimum zakat base for this investment at least equals the zakat payer's share of accounting profit reported in its financial statements. The foreign investments are considered as deductible only if zakat payers pays the zakat due on this investment in accordance with the zakat regulation based on the computation which is certified by the licensed accounting firm in Saudi Arabia. And main point, this investment should not be in a trading company. This investment should be kept as a long term and it should be for more than 1 year. So if you satisfy all of these 3 conditions, the company can able to get the deduction for the investment made on the entity outside KSC. Next point is value of the properties under development for sale. This can be claimed as a deductible assets in the zakat base, provided there are 4 conditions to be met in order to claim this as a deduction. First one, they should be classified as a non-current asset in your financial statement. This should be intended for sale only once the development is completed, and it should not be offered for sale at its current status. And the last point, the sales and advances received from the customer against this property do not exceed 25% of its value as stated in the financial statement. So these are the 4 conditions that you need to satisfy in order to claim deduction for properties under development for sale. So the next point is lease receivable. This can be claimed as a deduction under the project built, own, operate, or which is like similar kind of project. If company is into, then they can claim a deduction for the lease receivable in the zakat return. The most important update, this is where the most company would mistake on the zakat return. So as per the current regulation, the long-term loans has a maturity of 354 days or more, which overlaps between the 2 zakat years are added on the proportionate basis. This also includes if the same loan has been renewed or rescheduled with the same creditor or replaced by other source to finance the same. So under this criteria, so the long-term loan will get added to the zakat base. Just to give you a small example. For example, let's assume a company obtained a loan in the month of July 2019, and it is expected to settle the loan in the month of June 2020. So in this case, for 2019, as company has completed the loan has completed only 6 months of outstanding, and it is expected to complete another 6 months in the following year. So in this case, company is required to settle zakat on the proportionate basis for 6 months in the current year, and then remaining 6 months will be settled on the following year. So this is the important points that you need to make sure, like when you have any long-term loans in your books. So even if those long-term loans has not completed 1 year, it has to be prorated for the number of days it's outstanding in the current year and should get added to the Zakat base. And these are the key updates that we wanted to share with all of you on this webinar. Over to you, Tariq, again for Bahrain VAT updates.
Thanks, Dinesh. So to begin with, VAT return submission deadline for Q1 2021 and March 2021 monthly VAT returns is now the 3rd of May 2021. That's due to holidays. Next point is the Ministry of Finance and National Economy and the Shura Council are always looking at ways to reduce the national debt in Bahrain. But I've kind of ruled out raising the standard rate of VAT or introducing income taxes. However, we obviously know sometimes governments are forced to raise taxes where all other options are sort of exhausted. So it could happen in the near future. No one knows really. Over the last 3 years, Bahrain's generated approximately 934 million from VAT, excise tax, customs duties, and taxes in the oil and gas sector. Interestingly, the VAT revenue was 260 million dinar in 2019, but it dropped to 220 million in 2020. I'm not sure why that is. It could be because a lot of companies were claiming pre-registration import tax, so that could be one of the reasons. A bit about business restructuring. We know because of COVID-19 and other reasons as well, many businesses are currently undergoing restructuring. And we've noted that tax advice isn't always sought at the start. Just a point to say that it's important to ensure that formal tax advice is sought before the restructuring started, as often there are various sort of options available. And that applies to contracts too. Like we had a case recently where a business has found that it has to charge tax on recharges of costs because they didn't really take into account the tax implications before the contract was entered into, and now it's a bit late for them. The NBR's updated their website and they've included some new sections like which cover excise tax. They've provided sort of list of excise goods and the guideline of how to get refunds. And they've also included a section on foreign tax relations, including information on base erosion, profit sharing, and exchange of information requests. Might be useful to just have a quick flick through the website. There's quite a few updates on there. And the last update for Bahrain, the Central Bank of Bahrain has emailed some companies to advise that they have new country-by-country reporting rules, which are now effective in Bahrain from the financial year commencing 1 January 2021. And the CBB's advised that the form and method for submitting these reports and required notifications will sort of be determined by the Ministry of Industry, Commerce and Tourism. That's Bahrain covered, and I'll pass you on to Mark to cover off some UAE updates.
Thanks, Tariq. So UAE. Early March, the FTA released a business bulletin on the VAT implications for artists and social media influencers. So the FTA's bulletins are very high-level documents, really kind of aimed at, I guess, non-sophisticated readers and people that don't really know much about VAT or tax. So often case these bulletins don't have too much more information than what has already been provided. But this one really covered artists and social media influencers, basically saying, look, if you're conducting a social media activity through Instagram or whatever, you might have a VAT registration requirement. It's just one of those types of services that you often overlook because of such a, I guess, private, personal nature of it as well. So that was one update. The Federal Supreme Court has dismissed an appeal which was filed by the FTA against a Dubai-based beverage distributor. So this is one of the first times that the Supreme Court has actually issued a judgment in favor of the taxpayer and essentially removed all taxes and administrative penalties that were imposed by the FTA. There was a public clarification released earlier in the month around bad debt adjustments. So this clarification really didn't say too much more than what was already included in the law or the regulations, but it did confirm about the requirement to provide a notification to the customer that you're going to write off the debt before you can apply the bad debt adjustment rules. So the notification can be made through pretty much any channel, email, letter, post. You just need to make sure that in the notification you refer to the invoice number, the date of the invoice, and the amount that is written off. And also from a practical perspective, the clarification confirmed that if you're making an adjustment, you make it in the adjustment column of box 1 of the VAT return. So if you're operating in the UAE and looking at bad debt rules, have a look at the clarification. The FTA released a second business bulletin, this one covering the automotive sector. So automotive sector itself is a pretty complex area for VAT. There's a lot of issues that have arisen. So if you're operating in any of the jurisdictions, then you've probably come across some of these issues. One of the important points was about repairs conducted under warranty. So basically you have a local dealer who performs repairs under warranty and then recharges these repair costs to the overseas manufacturer. So there was always a bit of doubt as to what is the VAT treatment of that recharge to the overseas manufacturer. In FTA is now in this business bulletin has been very clear in saying this is subject to VAT at 5%, these recharge, which is obviously, I guess, bad news for the overseas manufacturer because they're unlikely to be able to recover that VAT. This position in the UAE is different from Bahrain. Bahrain came out with a slightly more complicated version saying it's out of scope, but to the extent that the dealer recharges like a margin or a markup to the manufacturer, then that marginal markup is subject to VAT. So that was an interesting update. And over the last few days, the FTA has released an updated public clarification on the temporary zero rating of certain medical equipment. So a few months ago, they basically came out and said things like face masks, surgical single-use gloves and surgical gloves and things like that would be zero rated. And they just provided a time period for that. And basically they've extended that to the end of this year now. So if you're in the business of purchasing face masks or gloves or anything, it's in the UAE, it's worthwhile checking if you've been charged back correctly. I'll pass over now to Tarek to talk about Oman and Qatar.
Thanks again, Mark. So just a few points on Oman. Everyone will know that the VAT executive regulations have now been released in Arabic and English. And another point around the Oman government announcing an economic stimulus measure. They included things like exemption from income tax for hotel establishments for 2020 and 2021. There's an exemption from tourism tax as well. That covers 10 March to 31 December this year. And they've continued a suspension of withholding tax on dividends for 5 years from 2020. So that's a whole sort of array of exemptions there. And there also reports a reduction in income tax for small and medium businesses more generally for 2020 and 2021. Due to COVID-19, the Oman Tax Authority is still accepting VAT registration applications for suppliers in the category of 1 million Oman Riyals plus, even though the deadline's passed. But the current registration group, which is live, is those companies or taxable people with supplies between 500,000 and 1 million Oman Riyal. And they have a deadline of 31st of May. Oman Tax Authority has been holding workshops as well, generally, to assist taxpayers with the VAT rules, similar to what other GCC countries did when they implemented VAT. And just a quick update on Qatar. The General Tax Authority extended the filing deadline for income tax returns for the 2020 tax year by 2 months. I've got no updates for Kuwait this month. And what I'll do, I'll just pass you over to Mark to go over some of the interesting points from the Oman regulations.
Thanks, Tarek. So I just thought quickly we'd touch on some of the I guess the points that are maybe different to other jurisdictions, because it's very common to fall into the habit of just assuming that Oman or any GCC jurisdiction is the same rules as other ones. So Oman have an interesting concept of responsible person. So this is a requirement for every taxpayer to nominate a person, so like a natural person who is essentially responsible for the entity. So this is different from other jurisdictions where they don't have this requirement. And it goes so far as to say, if this person actually leaves Oman for more than 90 days, you actually need to notify the tax authority and change your responsible person. So obviously, if you're operating on Oman, you need to think carefully as who's going to get this, this responsibility. Pre-registration input VAT is also slightly different in Oman. So you actually need to apply to the tax authority for approval to recover the input VAT incurred prior to your VAT registration before you can recover it. So that's a little bit different. Healthcare services are exempt from VAT in Oman, which is obviously different from Bahrain, UAE, and Saudi, where they're mostly zero rated or standard rated. So that's kind of thrown a spanner in the works for some healthcare providers, because obviously it impacts input tax recovery. For the oil and gas sector, it's also a little bit odd. So only upstream activities are zero rated, whereas anything really from the refinery process downwards is standard rated at the moment. So that seems to be an odd outcome. And finally, VAT return cycles appear to just be calendar quarters at the moment. We keep always preparing a draft, I guess a summary of the regs. So kind of pulling out some of these key issues, and we'll release that in our tax flash this week. So if you're operating in Oman and don't want to read through the whole regs, that summary could be useful for you. So that kind of ends the content presentation. I think we've had some questions throughout. I don't know, Tariq, if you've been following them. Should we just start?
Yeah, I'll just go through the sort of questions here one by one. We'll try to answer a few along the way, but some are just easy to speak about, and then we can send full responses with the sites by the end of today or tomorrow. I'll start. The first question I think we got was, we've purchased a company vehicle prior to 1 January 19 and the supplier didn't charge us VAT. We understand output tax is not payable if you sell this vehicle to one of our employees. Is that correct? So the car sale is going to be subject to VAT at 5%, and you're selling it in Bahrain, even though no VAT was incurred when you purchased it. What you will need to consider though are the fair market value rules, because employers and employees are considered as related for VAT purposes. I think the questioner might be confusing this slightly with the deemed supply rules, for example. So if you're giving the car away for free to your employee and you didn't recover input tax, then there may not be a deemed supply. So that's another part of that needs considering as well. The next question was, I'm not making any supplies in Bahrain currently. Do I need to deregister from VAT? I'll take this one as well, Mark, and I'll give you the next one, because I've been involved in a few deregistrations recently. So for Bahrain, a taxpayer will need to deregister from VAT if they sort of stop carrying on an economic activity, or they have not made any taxable supplies over the last 12 months. So this could be, like, due to COVID, some companies have just not been making any supplies. And by the way, these first 2 points apply to residents and non-residents, but there's another one where the total value of sort of annual supplies and annual expenses is not expected to exceed the mandatory registration threshold. So that only applies to residents. So there's quite a few things to consider, but if you've not made supplies for a while, it's definitely worth considering whether there's a requirement to deregister. There's a question on disposal of obsolete stock for minimum consideration. Do I need to obtain NBR's approval? And Mark, do you want to get that one?
So it's obviously talking about Bahrain VAT.
Yeah.
So there's special rules about notifying the NBR when you're disposing of obsolete stock. So there's obviously a definition of what constitutes obsolete stock. You do need to get the NBR's approval. I think you need to do it 30 days before you actually dispose of it. So what this is mainly getting at is for those, I guess, in retail where they've got out of date out of date products, or if they've got goods that that are, I guess, have not reached their use by date, but are just kind of being replaced by another line of goods, then you need to actually notify the MBR before you destroy them, just from the point of view that you've recovered input tax on it. So the MBR just want to make sure that you've either sold them or you've got rid of them in an appropriate way.
Yeah.
Do you want me to do the next one? All right. So
Yeah, cool.
there's a couple of questions on Zakat. So maybe for Dinesh, it says, can we deduct long-term lease receivable from Zakat base for our finance company?
Yeah, as per the new Zakat regulation, a long-term lease receivable can be deducted only in case of certain projects. Those projects are like build, own, operate, or build, own, those kind of projects. Under this project, if you have a lease receivable, you can able to claim deduction in your Zakat base, not on the other projects.
Okay, and then maybe sticking with Dinesh, there's another question here about Zakat. So our business is using land which is in the name of the owner. Can we deduct this for Zakat base?
Basically, the land has to be registered in the name of a company. In case of LLC, if the land is in the name of a company, then the deduction can be claimed. If it's in the name of the owner, the company cannot claim deduction on the land of the owner. So it needs to be on the company's name.
Okay, and then back to VAT, Tariq, where billing is done in Bahrain in relation to goods that are supplied and shipped directly from outside of Bahrain to another place outside of Bahrain, what will the VAT treatment be?
Yeah, I think we had a similar query to this. Was it last webinar or the webinar before? But on the basis that the goods are not physically located in Bahrain, and assuming that there's transportation involved, so the suppliers are responsible for any transportation, the place of supply looks like it's going to be outside of Bahrain. And so in this case, there will be no Bahrain VAT, and it's outside the scope of Bahrain completely.
Yeah, I guess we're based on when the transport of the goods place where it commences.
Yeah,
which makes sense. Dinesh, is there a penalty for late payment of Zakat?
As per the new regulation, there is no delay penalty or late filing for Zakat. But as per the new regulation, it has the provision for the Gazette. If Zakat payer is not following the statutory obligation of the deadline, then Gazette can extend the statute of limitation up to 10 years. And there is also a risk of getting a deemed assessment after the deadline. So we always recommend, even if there is no delay penalty on Zakat, the company need to stick to the statutory deadline, which is like 30th April for December year-end claim. And they need to submit the Zakat and pay the due Zakat liability before the statutory deadline, in order to avoid any risk of deemed assessment or extending your statute of limitation to 10 years. This is the risk as per the new Zakat regulation.
Tariq, reverse charge question. We are still not clear on when reverse charge mechanism transactions in Bahrain should be booked, as we often receive the invoices late.
Yeah, so this is an ongoing one. The NBR guides are not 100% clear on this, the law regulations. Some jurisdictions, they just say, well, go by invoice date. But obviously the issue there is sometimes the customer will tell the supplier, hey, don't invoice me in the next tax period because I have a better recovery rate. But I mean, generally speaking, for RCM, they're reportable according to the general sort of time of supply rules. However, practically speaking, from a Bahrain, for example, perspective, it's quite difficult to follow that because if you've not got an invoice, then I mean, there's a requirement to sort of mark, the exchange rate, et cetera, on that. So practically makes it difficult. I mean, I know not everyone, but a lot of clients are just going by invoice date just because it's just problematic trying to work out the time of supply for each imported service. Finance team are often not even aware of not what's been purchased, but when the sort of delivery of the service is taking place, and it's really difficult for them to work out. So in such cases, they're just defaulting it to the invoice. I've not seen NBR make an issue of it today. But But who knows going forward if they do? Unlikely,
Yeah.
but you never know.
I've not seen them make an issue of it either. I've got clients that are recording, I guess, based on payment date. But you don't really record based on payment date until you receive the invoice anyway. So I guess there's a question as to whether that's late then. But ultimately, I think if you remain consistent, you're probably not going to be in a bad position. Dinesh, there's a question here about deducting investments made outside of KSA, but I think you've already spoken briefly about something similar to this, right?
Yeah. This is a common question that we are getting from most of our clients while preparing the Zakat return. So they usually say, like, we have made investment in some of the foreign entities which are outside KSA. Can we claim deduction on this? So as per the regulation, there are 3 points you need to satisfy in order to claim the deduction. The first point, you need to settle due zakat on this foreign investment, which is certified by the public licensed accountant. And second point is, like, the minimum zakat base for this investment at least equals the zakat pay share of accounting profit reported in its financial statement. And the last point is, like, this investment should not be in a trading company. So if you can able to satisfy and justify this 3 points, then you can claim the deduction for the investment made in the foreign entities.
Okay, cool. There's one final question that we have. We've still got a couple of minutes, so if anyone has any other questions, feel free to ask them. But the last one that I've got here is, what is the VAT treatment of goods that are re-imported after a temporary export? Tariq, can you talk us through some points around re-imports?
So generally, where goods are re-imported into Bahrain after they've been temporarily exported, I think it's cutting off there. So where goods are imported into Bahrain after they're sort of temporarily exported outside Bahrain for sometimes, say, repair, completion, or manufacturing, or some other process, the value of the goods at re-import will be the value added to the goods when they were temporarily exported. So it's the additional sort of work that's done. And obviously, the customs law provisions will need to be taken into account when valuing these goods when they sort of come back into Bahrain. So it's not a straightforward query sometimes, and it's sometimes difficult to work out the value added. So this needs to be looked into probably some detail before the value is decided.
Yeah, agreed. It's one of those kind of tricky areas where there's I guess limited guidance on it, but normally when you really only want to tax the value that's been added to the product, because you've obviously already taxed the main component. Look, that's probably the end of the questions that we've got. I don't know, Tariq, Dinesh, if you had any final comments.
Just a couple of final comments. There was 2 questions I answered sort of online. So one was about the hotel industry, and I think it could apply to sort of other businesses as well. So the question was, in the hotel industry, we sometimes then cash to guests, for example, like taxi fares, prescriptions, flowers, or whatever. Sometimes they pay money, they give cash to the guest, and sometimes they pay on their behalf, and then they recover that amount or the total amount from them. And I think for these sort of expenses, it's important to consider whether the hotel is incurring and recharging costs as principal. I think we touched upon it was it the last webinar, I think. And if that's the case, then recharge is going to be taxable. So it's really important to think about the VAT treatment before you enter these sort of transactions, especially where they're repetitive. Sometimes the value is not high, but because they're repeated so many times, it sort of adds up. And there was one last point. There was another question. It was around import VAT on goods imported on behalf of a related entity as they don't have an import license. Is there an issue with that? Import VAT is only generally recoverable if it relates to your own economic activity. So if it's not related in relation to your own economic activity, it's probably not going to be recoverable, but it's probably worthwhile just setting out the facts and getting advice on that. And obviously the normal import tax recovery criteria would apply anyway. So that's all from me, Mark. No further comments.
Great. And Dinesh, did you have anything else to add?
Just to update one thing, like most of the clients, like they don't understand like why there is a increase in zakat rate from 2.5% to 2.578%. So the reason behind this increase is like in the earlier years, Gazette you to consider Hijri year, which is like 354 days in a calendar year, which is subject to 2.5%. But now Gazette is adjusting the Hijri year to Gregorian year, which is 354 days to 365 days. So this 11 days carries that extra percentage of 0.578. So that is the reason, as per the new regulation, the zakat rate is like 2.578%. So this is the reason behind that increase. So this is what I need to clarify.
Great. Look, that brings us to the end of the webinar. Thank you all for dialing in to listen. We'll be holding our next one in the second week of May. I'm not sure what the date is. They're always held on the second Monday of the month. We will forward these slides out to everyone. There should be a recording of the webinar as well uploaded to YouTube, and we'll answer all the questions in writing and forward those. But thank you everyone for dialing in. If you do have any questions, always feel free to reach out to any one of us from the Keypoint team, and happy to help. But thanks everyone. Have a great day.